Another day, another new all-time high for the stock market. Ladies and gentlemen, welcome back to the channel. I will break down all of your breaking news you need to know today, why stocks are breaking out, and what could be coming next for this market. Is it time to fade the rally or double down here? I'll give you my insight in this video. First things first, before we get into all of your breaking news, I just want to point out one thing that I talked about precipitously on this channel within the last week or two. We were due for a consolidation phase. That is exactly what happened. You fell for about 2 days, okay? Little bit of a consolidation here. You reset lower, about 1-ish%. Now you're back to new all-time highs. But what actually happened, if you look at the RSI, the relative strength index, you were at 76.26. Now you're back down to 72.46, even though you hit a new all-time high today. So that consolidation was necessary to allow markets to move to new all-time highs. Now, you're still a little overbought on the RSI. Markets could go higher from here. That's not to say like you have to peak out as soon as the RSI gets overbought. In fact, the RSI on the SPY, once it gets overbought, tends to go into the 80s before you see an actual consolidation and or correction. So this is actually a very healthy sign that we're seeing in markets. So first things first, some of the optimism today comes from Fed Waller. Fed Waller reiterates the case for why July rate cuts could happen. He says, quote, an easing would not be political. He says that unemployment is around the long run level. Marjorie Taylor Greene has introduced the No Tax on Home Sales Act to eliminate federal capital gains tax on home sales. Fed Waller says, I have been arguing a pretty restrictive policy rate can come down. Waller says that tariff effects are not zero, but they are not large either. He says that tariffs increase prices one time, that central banks can look through that. And that's really, I don't know why this is an argument. Just let me ask you logically, as you guys are on Main Street, do you think you could go to your employer today and say, hey, tariffs have hit, prices are up, I want a $2 raise an hour, or I'm leaving. This is my 2-week notice to give me $2 an hour of a raise. What do you think your employer is going to do? If you're not fired, you're definitely going to be put on the shit list. Okay? You're not going to be around much longer. This is not an environment where you can demand higher wages. That's the principal argument from tariffs causing inflation. It's not that tariffs are inflationary. Tariffs are a tax. By definition, tariffs are actually deflationary because taxes are always deflationary. Okay. The argument is that prices go up from tariffs one time, and then people ask for higher wages. They get those higher wages, and then you enter into an inflation snowball from people getting paid more. Unfortunately, this is not the economy where you can start demanding raises. It's just not. And I don't think it's really an economy where companies can pass on tariff costs to consumers either. I think consumers would say, yep, we're just going to buy less. And then that doesn't benefit the company, right? You lose market share, somebody else steps in for cheaper, takes your market share. That's not a good thing for a company to do. So I don't think you're going to see any inflation from tariffs. Not any at all. Waller says that stablecoins could depress demand for cash and the dollar could be more widely used. The U.S. State Department braces for mass layoffs as soon as Friday. Brazil's Lula on U.S. tariffs says, quote, the main thing is the reciprocity law. If he charges us 50%, we will charge him 50%. And along with stocks and the SPY hitting a new all-time high, the S&P 500, Bitcoin also hits a new all-time high today, over 113,000 per coin. Fed Waller says the Fed holds too many long maturity assets right now. And that's kind of the argument from Trump is, hey, we're going to front run or front load, if you will, the funding the government with short duration bonds, like 1-2 year bonds, 3-month bonds, 6-month bonds, because rates are going to come down a lot over the next 2 years, and that's when they're going to lock in a lot of the long maturity assets. But Fed Waller says the Fed themselves holds too many long maturity assets. Fed Waller says the Fed should consider shifting holdings more towards treasury bills over time, which I think highly aligns with Trump here in his thought that he wants lower rates. If the Fed came out and outright started to be a buyer of treasuries again, that is quantitative easing. That would be, that would push treasuries lower. We did have a 30-year bond auction today. When issued yield at 4.890%, bid to cover ratio at 2.38. This was a $22 billion bond auction, and they awarded 60.85% of the bids at the high. So this was actually a very strong bond auction today, sending long duration yields slightly lower. JP Morgan CEO Jamie Dimon says, I would price in a 40 to 50% chance of higher US interest rates. He doesn't mean the Fed raising rates, okay? He means that the fiscal outlook is just so bad that rates will go higher. Because I think a lot of people forget this, but yield is correlation to risk, okay? If you see a 10% yielding dividend stock, that is because people do not want to own that dividend stock at 5%. At 6%, at 7%, at 8%. They want to be compensated for their risk. So theoretically, as we're going to run $2.5 trillion deficits over the next 2 years and grow the debt burden by, call it $5 trillion in the next 2 years, if you don't have massive economic growth to offset that and not make that as bad, in theory, you should have higher interest rates, right? Investors should be compensated for higher risk. Higher risk of what? A default, right? Now, some people are going to say the U.S. is never going to default. Okay, that's the overarching kind of thought process. And that's why rates are not blowing out to the upside right now, because people believe the U.S. will not default and that it's still low risk. But Jamie Dimon is saying this spending bill has raised the risk profile of the U.S. government, which is factually true if we do not see AI drive massive growth and higher productivity. So it's something to watch out for. But even as Mike Wilson said yesterday on CNBC, the markets are giving the markets the benefit of the doubt, and they're saying, hey, there's probably a greater chance than not that we actually outgrow the debt. And that's why bond yields are not really reacting to the quote unquote big, beautiful bill. Because Wall Street's saying maybe AI could be so impactful to productivity and to growth that the debt is not actually as bad as it looks on paper. Donald Trump this morning on Truth Social says tech stocks, industrial stocks, the NASDAQ hit all-time high, record highs. Crypto, quote, through the roof. Nvidia is up 47% since Trump tariffs. USA is taking in hundreds of billions of dollars in tariffs. Country is now, quote, back. A great credit. The Fed should rapidly lower rates to reflect this strength. USA should be at the top of the list, and there is no inflation. This is great, okay? From an investing perspective, Trump is back, or he never left. He cares about the markets. It is Trump's report card again. Safe to say. I mean, he's literally using it to flaunt the success of his administration, for better or for worse, from a political perspective. Whether you like this or not, it's good for your investments. And that's probably another reason why stocks are doing well today. Quote, buy the dip strength in the NASDAQ in 2025 has been one of the strongest ever in its history. currently run rating above the historically strong tech bubble years of 1998 and 1999 per Bank of America. What's actually interesting here is Tom Lee recently noted that hedge funds and institutions are more bearish now than they were in 2023. That they're not exactly bullish at this moment, which is fascinating because retail investors, they have been carrying this market. We were the ones that were buying the dip when markets were down 20%, and we are the ones continuing to buy this market. Wall Street is behind, okay? The chase is starting. And even as Tom Lee recently noted, a new bull market technically started from an algorithmic perspective, from a Wall Street perspective, at around the 610 level on the SPY. You're only about 2.78% into a new bull market. So this new bull market is in the baby stages, and there's likely a lot of room to run from here. And as I've really talked about many times on this channel, the bull thesis is strong. Let me tell you why it's strong. In a nutshell, it doesn't matter about 2025 anymore. We're looking ahead towards 2026. What can we expect? Well, geopolitical tensions are dying down after ramping up. That's one thing. Trade deals are getting done. Commodities are falling. Energy, different metals, commodity prices in general are falling, which is leading to no inflation. We essentially do not have inflation in this country. Okay, so you have no inflation, geopolitical backdrop that is improving, commodity prices that are coming down. We have the funding bill, which has massive deficits, which is stimulative to the markets. Okay, again, trade deals are getting done, so that's kind of seen as in the rear view mirror. We have a new Fed coming in May, which is projected to cut rates a lot next year. Okay, which imagine that. Imagine what happens to this market as we actually get rate cuts. Now, they have to be for the right reason. If the Fed is cutting rates because the economy is getting weaker, that's not great. If the Fed is cutting rates because we don't have inflation, but the economy is strong, that is very positive, okay? And that's important because I think the economy will be strong. I think this economy is a lot stronger than people give it credit for. Why? Because the last 3 years, people have felt like they've been in a recession for years now. Yet the economy has remained out of a recession. The American consumer, the American citizen is stronger than you would believe. Okay? If you make minimum wage, even 2-income household, you've been struggling for a while here. One thing I do like in the big beautiful bill is no tax on tips, no tax on overtime. That's going to help people out a lot, and we know people spend all of their money. That directly will correlate to stronger earnings. Okay, so this is all kind of the backdrop for next year. Add on to that, AI. What the future of AI looks like is bright. When you put all of this together, strong economy, no inflation, clarity on the funding bill to fund the government, big beautiful bill, higher deficits, which are stimulative to markets, AI, bunch of rate cuts from a new Fed chair. I mean, it's hard to be bearish on this market. You really have to expect that just randomly the economy weakens into a recession, which historically has not happened in around 5 decades, right? 50 years. We just don't fall into recessions, okay? America's got like the strongest legs in the world. We don't just fall down the stairs in a recession. It comes from shock events. If a trade embargo that was like a month long with China did not cause a recession, which I would say it's probably too, some people would say it's too early to tell, but I'll make that call now. It did not cause a recession. I don't think anything else is going to cause a recession at this point, unless there's some kind of big credit event where credit dries up. You're not going to have a recession. So Wall Street is slowly starting to realize what I'm saying, that the outlook for 2026 looks incredibly strong. And they're trying to get positioned in markets now for that, because markets price things in ahead of time. So I think just in terms of AI, productivity growth, the fact that everyone got bearish on markets, got bearish on the earnings outlook, and now they have to say, wait, earnings may actually come in really good next year, is going to lead to a lot of new positioning. There's a lot of Wall Street that was underweight this market that had to deposition from this market because of how risk profile is set up, right? As the VIX spikes, as stocks fall, hedge funds and institutions do not have the luxury necessarily that retail investors do to just hold and buy, right? A lot of hedge funds and institutions have to reduce risk as the VIX goes up and stocks fall. So a lot of hedge funds and institutions completely missed the 20% drop, the opportunity that comes from that, buying at the lows. They were analysis paralysis, okay, at the lows. Retail bought the lows. Now it's their job to chase, and that is what they are doing. Now, on that note, ladies and gentlemen, before we continue with this video, I just want to point this out. If you guys want to come trade with us live in real time, check out that link down below in the description of this video. We are looking for the big AI winners, the companies that people do not know about, the next 10, 20, 30, 40, 50x opportunities. I believe we are heading into an AI supercycle, and I'll be damned if I miss that. I'll be damned. I will not let it happen. I spend hours every day researching small caps, trying to find the opportunities. And when we find them, we invest in them. Year to date, this portfolio is up 65.92%. Yeah, this is pretty much beating every hedge fund or institution in the world. Okay, there might be a couple that are up a little bit more, but this is top 1% by a long shot. Top 0.2% by a long shot. And I think it's just the start. So again, if you guys want to come trade with us live in real time, every time I make a trade, I send out alerts, update positions whenever I update them, and keep you informed of what's going on with the stocks that we invest in. Check out that link down below in the description of this video. Obviously not financial advice. Read the disclaimers, all of that, verify due diligence. But come check it out if you have not done so already. Link down below in the description of this video. Now, back to the video. In the news today, the proposed Trump administration's import tariff of 50% on Brazil would halt the flow of Brazilian coffee to the US. Jamie Dimon says AI could be everywhere and will disrupt jobs and companies. Well, yeah, that's probably the one thing I believe that he's said in a while. AI will be everywhere. It is the biggest transformation of your lifetime. This is the equivalent of the internet, in my view. If you didn't invest in the early days of the internet, if you didn't invest in Microsoft, Apple, Google, Nvidia as they came out, as they were small companies, well, the next best thing, or probably the even better thing, is investing in the AI companies that are small today, that you think could be big winners in the future. Because AI, 20 years from now, is going to be critical. And even Jamie Dimon is incompetent here. He says tariffs, in my view, are inflationary. They won't come in all at once. Like, it's surprising to see so many successful people, by definition of success, so uneducated. Tariffs are taxes that are paid by consumers. The only way tariffs are inflationary is if there is so much money sloshing around out there that you can, yes, raise prices on consumers, and consumers are willing to pay that, and there is virtually no slowdown of consumer consumption, which, again, if Doritos go from $5 a bag to $7, I think people are going to buy less Doritos. I don't think there's so much money out there in consumers' hands that they would be willing to just keep paying higher prices. Okay, that's number one. But number two is I don't think the labor market is in a place where you can demand higher wages because of tariffs. I think your boss would laugh at you and say, hey, you're going to get your 3% yearly raise as you typically do. Get out of my office. Stop asking, right? Or put in your 2-week notice, pack your bags and leave, right? That's the response you're going to get if you try to justify a 10% pay raise, for an example, because of tariffs. They're going to laugh at you. They're going to find someone else that'll do your job and accept a 3% pay raise per year. Unless I'm missing something, yeah, tariffs are not inflationary. A lot of people have forgotten the lessons of Milton Friedman that go something like this. Inflation is always a monetary phenomena. Like, we're talking about tariffs being inflationary. What could be inflationary is deficit spending, essentially money printing. Inflation is always a phenomena of money printing. Okay? Tariffs are not money printing from a basic Econ 101 perspective. It's not. It cannot be inflationary by definition. But Trump's bill could be inflationary. So if we really want to talk about inflation, it should be the deficits. That could be inflationary, but not tariffs. And I don't think that will be inflationary. But if we wanted to talk about anything being inflationary, it's the quote-unquote big beautiful bill. It says real data on the U.S. economy is totally impossible to read. Fed Musaliam says we expect tariffs to begin impacting inflation starting in June's data. You know what's funny here? If it doesn't happen in June, they're going to say, oh yeah, we expect it to start showing up in July's data. Now, the June inflation report comes out next Tuesday. Wall Street has expectations for core month over month at 0.3%. Last month, it was at 0.1%. So if that comes in low, you could very well see the odds of a July cut skyrocket. The odds of a July cut at the time of recording this video sitting at 5.3%. If we don't see that inflation come in next week higher, then yeah, there's really gonna be it's really gonna be a slap in the Fed's face. Fed Musaliam also says so far the tariff impact on prices appears to be mild, though it is early in the process. Fed Musaliam says we had positive inflation trends the last 3 months. And he says it is too soon to tell if tariffs will have a one-off or a more persistent impact on inflation. This morning, we got initial jobless claims that came in lower than expected at 227,000. The expectation was 235,000, and last week was revised down 1,000 from 233,000 to 232,000. So some good economic data, if you will, this morning. Initial jobless claims tend to be very tight run data sets. They come out weekly and it gives you a read on the US economy. And then besides that, just a bunch of Fed speakers today. Fed Daily, Fed Waller, Fed Musaliam. Again, kind of back and forth, like some good headlines, some bad headlines. But I think markets right now are really looking ahead to having a new Fed. And I don't think markets are super worried about inflation. And with that new Fed, we're going to get a lot of rate cuts. That's what markets are really focused on at this point. Here today, the CNN Fear and Greed Index is coming in at 76. In the just barely an extreme greed. Market momentum is greed. Stock price strength, extreme greed. Stock price breadth, extreme greed. Put and call options, extreme greed. Market volatility is neutral. Safe haven demand is greed. Junk bond demand currently in extreme greed. We did get a new AI investor sentiment survey as well today, showing bullish investors fell about 4% from 45% down to 41.4%. Neutral investors rose from 21.9% to 23.0%. And bearish investors rose as well from 33.1% to 35.6%. So still what looks like more bulls than bears, but there's definitely a healthy level of bearish investors still out there, well above the historical average of 31%. And here today, the percent of stocks trading above their 50-day moving average coming in at 76.40%, up about 2% today. On the higher side, but it really just tells you this market has seen a lot of participation, right? It just tells you that a lot of stocks are trading above their 50-day moving average, that markets got really oversold back, during the crash. At one point, only 5% of stocks were trading above their 50-day moving average. And now a lot of stocks recovered from the lows. It doesn't exactly tell you that we're like due for a fall or anything like that. But typically, you can get into the high 70s into the mid 80s before you do tend to see a bit of a pullback. And I think that is kind of correlating to some of the consolidation we have seen in markets recently. And I'm expecting the consolidation is probably going to continue. You could continue to make your way to new all-time highs slowly but surely. I think some sideways trading action is in the cards between now and September. I think the last couple of months of this year, especially if inflation does not show up, are going to be really strong as people focus on 2026. And I think the chase is on as we start to view 2026 as it's probably going to be a pretty good year for corporate America. I think it will be. I think Wall Street has a lot of room to get more bullish on this market. I think retail has been bullish and they've stayed bullish, but it's hedge funds and institutions that are really going to start chasing into year end. But in the short term, expect some additional consolidation. We could move into the 630s on the SPY and then consolidate for a period. So I'm not saying immediately we're going to fall again, but some consolidation would definitely be on the healthy side. Let me know your thoughts on all of this down below in the comment section. Hit that like button and subscribe to the channel if you have not done so already. Have a great rest of your day, and I will see you in the next one.